Hello and welcome everyone to another video. I hope you all are having a wonderful weekend, a wonderful day, and a really good trading journey. You guys know that all of my videos are about the market, are about like finding out different kinds of approach to the market, but this one is a bit of a classic. In this video I want to show you all the ICT's unicorn model, right? Which is a really easy and convenient pattern of the algorithm, which helped me a lot in the beginning, right, to catch really amazing moves. Let me show you what actually unicorn is. Let me show you first the logic of unicorn model. All right, for a unicorn model you need first, for everything in fact, firstly you need is a key level. Okay, this is your key level. Now if you're trading CRT, I don't want to talk of CRT right now, I just want to explain to you the model. All right, you need a low, a high, low stabbing into the key level just like we do at CRT, right? This low breaking this high and then finding support over here and then rallying. This right here is a breaker block. This one right here, right? So all that matters is for you to find a fair value gap over here in this breaker block. If this is a breaker block and you get a fair value gap right here, this is a bullish example, right here is a fair value gap, right? Now this becomes a unicorn model. If it doesn't have a fair value gap, you can call it, but then this makes it a higher probability. Why? Because it shows that there is an imbalance going on around here, and then price is rejecting this from this key level and wants to deliver higher, right? And then same scenario goes at what, the opposing idea. So you have a high, you have a low, you have a higher high, a lower low, and then at the lowest close you look for your entries right here. Now the same idea which is applied for the bullish scenarios is applied for the bearish scenarios. Now this is the breaker, right? And then you need to enter from this breaker right here, and then you're putting your stop loss where, either at the high of the breaker or at the high of the the actual swing point, and they're targeting 2RR or whatever is your criteria. So this is it for the logic, right? What you all need is, let me explain it to you guys on the charts. Why is it so easy, and why is it so really convenient for you to spot? And then if you're not able to gather different strategies, you're like working on different strategies and nothing is working, and you're trying to flip from one strategy to another, this one would be the only strategy which you need. That would be the only strategy which you need. For example, right here, right, you have a low, you have a high. You can see the example right there. There are multiple examples of breaker blocks or unicorn model. You have a low, high, lower low, one high, low, and then here we break above. You can see right there we broke, came back to the breaker, right? This is the breaker. Price respecting the breaker, the following day it just delivered higher. or the following week. The idea is this: since this is the 15-minute time frame, it took a little bit of time for it to come back and then deliver higher. But then every single time you'll see, if you see this pattern at your desired key level, that is a really good entry right there, especially if it aligns with a new week opening gap or a new day opening gap along with a fair value gap, right? And then a breaker block which is aligned with a new week opening gap. Suppose, let me just explain it to you guys in a really simple manner. This is a bearish scenario, right? You have a low, you have a high, right? And then you have a low right here, and then high, and then it breaks down like this. Now here, either one, let's suppose this is your breaker block right here, okay? Now if this breaker block right here is aligning with a new week opening gap, suppose over here there is somewhere a new week opening gap right here, right, on a 15-minute time frame or a 5-minute time frame, anything. If this is a new week opening gap and then the breaker forms right at that new week opening gap, that increases the probability of that breaker block like tenfold, 10 times more, right? So now you guys can see once again, like it's everywhere, like you know, it's not that it's something rare or anything. Like all you have to do is just spot it: high, low, lower, high, price break above, come back down, and then it continuously deliver higher, right? This was a bullish scenario. Let me find a you can see we have a high, we have a low. This is a bearish scenario: higher high, price broke down right here, right, or maybe here, comes back and then delivers lower. Now you'll be wondering why it didn't touch you know, the breaker exactly. Let me clear this out for you guys. You can see this candle right here, right, this one on a Sunday came down, closed below. The next candle during the Asian session went up into the breaker and then delivered lower. You see? And if we can find a bullish example right here somewhere. Yeah, so you have, this is the low, right? Let me put a marker. This is the low, this is the high, lower low, higher high, along with fair value gaps here, right? You can see 1, 2, 3, and then it's continuously forming. Price returns back into where? This one particular breaker, and then price respects while it delivers higher. Now of course you have to make sure that you put up the time factor, of course. Number one, step 1, identify your key level. Always make sure that you identify your key level, which is either daily fair value gap or a daily order block or a daily breaker block itself. You know, a breaker block can be a PD array, and major highs or lows or new week opening gaps, right? Step 2, wait for the right time. Time is really important. What are the times which we trade between? 3 a.m. You look for your breakers after this time, all right? London time, 4:30 a.m. and then Another one would be what? 9 a.m. till maybe 10:30 or 11. Till 11 you can find. Like for me at least, I suggest, do not just limit yourself to something. Instead, expand your horizon. While you need to make sure that the time factor is taken care of. Step 3 is you need to look for a low forming before the key level and then a sweep. The sweep or liquidity raid, grab, whatever you want to call it. Step 4, you wait for a fair value gap, which also we call as imbalance, right? And then step 5, enter from the breaker, and then the stop loss below the breaker blocks low or the actual sweeps low, and targeting 2RR or 3RR, whatever you want to target, right? It's up to you. But the thing is this, it will not always work. Like every other strategy, this is one of the strategies which will not always work. Suppose, for example, oh my goodness, right. And this price leg, okay, we spoke of this fair value gap acting as resistance like before in my previous videos I did. If you're on a daily time frame, you go on a 1 hour time frame. Okay, now on a 1 hour time frame you can literally see there was an SMT before, right? And we have what? A sweep, and then we have what? Price break below here, and then we also have a what? This is the key level, right? Daily fair value gap, and then on a 1 hour time frame we have a fair value gap right here, and then price is delivered right at the, you can see the OTE of the fair value gap, right, or above the 50%. So you can also use the OTE in the fair value gap as well. If you guys did not know this, you should know it right now. And then this has to be the lowest down close candle right here, and then you take your trade right here, and then stop loss at the highs. Either you target the recent liquidity or you target 2RR. It's up to you. So this is what happens when you trade the higher time frames, right? Even there was a rejection block right here. So higher time frames are always high probability. They always follow. But then if you go on a lower time frame, let's see if you have the same scenario on a lower time frame. Now, that was the whole idea of the higher time frame, right? This one. On a lower time frame, if you have a balanced, an IFVG as well, along with a fair value gap right here, let me show you the whole idea. We had this high, low. This is also a swing high, I would call it. Why? Because there are two, swing low here, swing low here. So this is a high, swept, price broke below, this candle broke below along with fair value gaps right here. There are two imbalances which we have, right? And then you can see price tapped into it right here with this candle, and then it was exactly when 3 a.m. price dropped. See, so the time factor came in between, right? Key level came in between, key level plus SMT, and then it just delivered. Now the thing is this: if you enter from the CISD, like this was the candle, right there, as soon as this candle closed, you want to enter in this candle, you would you might get a good entry right here. But a unicorn model, actually, it's a major confirmation that price has delivered, right? And they mitigated this block, this order block right here, because they were buying here, right? Sold here to buy, right? Sold here to buy, and then bought here last time to sell off. While they were selling off, this is the logic. Now this buy position here is coming back into a loss, so they want to load off their losing position at break even. So they have this candle right here to break even from 1, 2 times, and then the moment they closed their positions, right? So this was a return sell order, right? If you're a buy order, you have to sell back to close the position, and then it just sold off. You can see this is the logic behind it. You understand this? And then after that you wait for OTE and everything. This is the whole idea. So in a bearish scenario, the lowest candle right here, the lowest close, shall be the breaker block, or you can use this one as your entry, the up close candles, or the lowest low right there. Anything, they all make it really difficult for people to choose the right ones, but you can choose it. It's up to you whether you wanna. You will have a low kind of risk to reward ratio, but then your entries will be secured. All right, the same idea panned out here. You can see price came below. Now it formed a high, broke above, came back into the fair value gap, and then the order block, and then just ripped off. Of course, this aligned with CRT and quarterly theory, it's just wonders. It just wonders, guys. It's wonders. Alright, so I hope you understood something with this video. This was a really tiny little video of the model. There are a lot of things which are remaining in this. I cannot literally show you all in this one video, and that will be for another video. But unicorn model, if you follow it properly, there is nothing like it. Like, you don't need any other particular model to trade with, right? But also it fails. Like, if it's it fails for the same reason any other strategy fails. For example, right here, low was swept, high was broken, right? And then price just I don't know, it just messed up everything. Why? There are multiple reasons why. Order flow, their trend is bearish, as well as there is news coming in, sequential SMT or SMT, whatever. But you guys have to understand, this is just one model. It's a pattern. It's a pattern you look for at your particular key levels, right? And it's not that it's 100% foolproof or something. You'll face losses again and again, even using this thing as well, right? So yeah, that was it for the video. I hope you guys enjoyed it. I'll see you in my next video. Good luck and good trading.